It is reversal day for the markets as we start off on a very high note for risk sentiment and then not midday serious selling. And whether you want to attribute it to geopolitics or whether you want to attribute it to the markets finally hitting their saturation point for bullishness, one way or another, we do not close with happy vibes. And looking forward, it is all about a very, very critical thing here: the March U.S. jobs report. Because whatever happens next, whatever you might think about the implications of this sell-off, its ability to last, its ability to keep going, it is this that will be the next touch point in the story, at least as far as the forecastable ones. Surely nobody can know for sure if World War III is going to break out, though some of the headlines now around the world certainly seem to be flirting with that idea. But we have data on the calendar, and that's something we can have some sort of a forecastable conversation around. And so that's what we're going to be focusing on here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We're going to lay out the expectations. We're going to see what inputs go into what is the balance of scenarios for tomorrow's release and how it might impact financial markets. So let's begin with the baseline expectations. Non-farm payrolls, the green line that you see on the screen there, that's the monthly increase in non-farm jobs in the US, both private and public sector jobs. And the expectation is that we are going to see an increase of 200,000 jobs in the month here, which would broadly register in line with the trend average. So if we consider here where this has moved, and you can kind of see with the naked eye here that it's been something of a flat line in recent months, but the 12, 3, and 6-month averages here for monthly job growth in the U.S. range from 232,000 to 279,000. So this would be broadly within the range if we were to get an outcome something like what is expected. So you can see most recently the range has been defined between about, let's call it 136 and 500 as a kind of barometer on the outer layers of the range. So here and here, we kind of cooled off here. This is sort of the outer layers of the range that we've been in. And since then, it's been kind of a flat line in here. And you can see 200,000 would fall well within that range. It is generally the same story for the unemployment rate. Expectations are that it's going to hold at 3.9% for a second consecutive month. Another outcome that's broadly within the range. If the range high here going back to the beginning of 2022 was 4%, and the low from the early parts of 2023 is 3.4%. So 3.9 is near the top, but still well within the band here. And so really outcomes, give or take in line, don't present anything that would necessarily take us off of a familiar setting for the U.S. labor market. The larger issue is this: average hourly earnings. Now, if this looks like it's a flat line, it kind of is. And this is really the big part of this equation. Notice also that the expectations here and the recent numbers are all north of 4, which means that we have at this point a situation where wages are growing, depending on whether you look at CPI or PCE by about 1 to 1.5% faster than inflation. That, of course, is supportive of consumption. Consumption is the largest component of US GDP. And so we have a situation here where the bedrock of support for the resilience of the US economy is really underpinned by this robust wage growth, which hasn't really come down nearly to the extent that inflation has. And we'll take a look at that in detail in just a moment. But this right here is the big part of the story. And you can see here that for this release, we're expected to come in from 4.3 down to 4.1. 4.1 wouldn't be catastrophic, would still be well north of where inflation is, but it would be a significant decline. This would be the lowest reading that we've seen for quite some time, as a matter of fact, a multi-year low. So if we consider this in context, the last time that we were anywhere like this would be June of 2021, where we had 3.9% wage growth. Since then, it has been decidedly 4.3 or higher. And just for reference, the peak there is 5.9%. If we compare that with U.S. inflation, then current U.S. inflation based on CPI, 3.2%. And inflation has been below wage growth since April of 2023. So we're looking at something that is inherently supportive of the economy, and it is progress on this, and by progress I do mean that this goes down, that the Fed is most interested in. Not only because as this goes down, you start to push down on the business cycle and on inflation through this last mile of disinflation that the Fed wants to get done, but because the last lingering pocket of sticky price growth that the Fed can really influence is this. It isn't the housing component. That's arguably something the Fed has inadvertently done by itself with the rapid rate hike effort that has pushed both buyers and sellers out of the housing market. And so transactions have basically stopped. Things have locked up, and you have a housing market that can't clear. And so prices are stuck at high levels because nobody wants to sell. And that makes sense. If the average outstanding interest rate on mortgages now, mortgages that are already incurred, is under 4%, and market rates to take out a new mortgage are just under 7%, who in the world wants to sell their house and refinance something that's that much more expensive? So sellers are discouraged. Because sellers are discouraged, the price isn't falling. Because the price isn't falling, buyers are discouraged. And of course, they would have to finance as well. Though if prices were falling, maybe a 6%, 7% mortgage rate would be more palatable, but they're not falling, not in earnest. And so you have that component there almost as a function of the Fed's rate hikes. Not much the Fed can do about it until it cuts. But this is an area where the Fed can have influence. And so this is exactly the problem that we see. Notice the flat line here, very much the story, as we can see from the ECI, that's the employment cost index, which is, in my mind, a little bit better of a measure of wage inflation overall than our average hourly earnings. And you can see there, they've only come down from 5.1 to 4.2%. Whereas the Fed's favorite inflation gauge, the PCE index, has come down in the case of the core from 5.6 to 2.8, and in the case of the headline from 7.1 to 2.5. So the drop in inflation has vastly overshot what's left of inflation in the labor market. And we are very much looking for the Fed to gain confidence in this part of it to move forward on rate cuts. We just heard from Jay Powell again this week saying, we're not so sure that the latest uptick in inflation is anything more than a bump in the road. We still think that we need to cut this year, and we're going to sit on our hands and wait until we have more confidence. But for us, the next steps are to ease, as far as we're concerned. And ostensibly, what that is built around is the idea that this last pocket of inflation stuck in labor markets is going to start to unravel with greater vigor. So what this average hourly earnings number is going to do is ostensibly much more important than really what happens at the headline NFP number or the jobless rate, unless, of course, there is some shock surprise on either of those, which is, by virtue of being shocking, is inherently unlikely. And so what we have here then is a situation where the focus, as ever, is on how many rate cuts the Fed can get away with reasonably after this data. Now, if we were to get a relatively strong number, then obviously the expectation would be that the scope for easing is more so diminished than not. And there's some indication that there's upside risk. If we look at what's going on with job openings, we just got JOLTS data this week. They've stopped falling. Now, the number came out basically in line with expectations, but very clearly here, while we were steadily sliding from 12 million to now under 9, we've kind of gotten stuck here under 9. Job openings are holding steady. Now, of course, this is still quite elevated relative to where we were before the pandemic. And if we can just go back to this chart for a second, we can see that if we look at the supply and demand imbalance for U.S. labor, that's the blue bars that you see there, we still have about a 2.3 million worker deficit. And the way that that's calculated is we take all of the people in work, we add to that the job openings number, and that tells us how many people employers want to be employed. And we compare that with the number of people that are employed and unemployed, which is by definition not in a job but looking. And so we can see that the difference there is still a shortfall of 2.3 million, which is not a trivial amount, though of course it's down from 6.1 million at the post-pandemic peak, which, by the way, is also right around the peak in inflation, especially core inflation, shock of shocks. And so what we have here then is at least some indication that as this has come down, as this has eased, as the deficit has diminished, largely because of this decline in job openings, we now have a sense that maybe the process has stalled. And maybe that is the kind of thing that sets us up for a stronger jobs report that then sets us up for fewer Fed rate cuts. Similarly, positive indications from the ADP private non-farm employment number. This is from one of the largest HR data processing and management companies. It's not the world's greatest predictor of NFP, to be sure, but here we got the sense that things were more chipper than expected in March. 184,000 private sector jobs added, according to this. That's against expectations of 148. So again, fodder for upside surprise risk. If we look at the way that U.S. economic data has performed relative to forecasts recently, this is data from Citigroup, it seems to be heating up again. So from about mid-February or so, or mid-March rather, about March 18th, U.S. economic data, after a bit of a sluggish spell here, is once again reaccelerating, pushing through its 20-day moving average, which is a kind of trend barometer here where you can see when you get durably above it, tends to be a run. When you get below it, tends to be a run. It was obviously a big thing at the beginning of this year where you saw we got through this and rallied. And because we did, the expectations for Fed rate cuts in the market basically halved around the hotter data. We could see more of the same here. It again seems to be attempting to move higher. But this is not a one-sided sort of thing. We just saw data this week that showed us a stark difference between what's going on in manufacturing and the service sector. And of course, it is the service sector that matters because it is 70% of the US economy and overwhelmingly the largest employer. What we saw here was, in fact, the lowest growth rate for US services in 3 months. Unexpectedly, by the way. Note, we were looking for 52.7 on this, and this is, as ever, in the logic of PMIs. So over 50 is growth, under 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. On the manufacturing side, you had an upside surprise where manufacturing was expected to contract again. As you can see, it's been contracting since about the middle of 2022, and it actually returned to growth. Services, though, which is the much bigger component and the much more important one, undershot by a wide mile. And so we have here the beginnings of what the Fed might be talking about when they say, yeah, don't get too excited. We still think we're going to need to cut. It is especially eye-catching, of course, that in both of these surveys, employment shrank. Now, in manufacturing, it's been shrinking for a while, since late last year when it briefly saw a bit of growth. The trend here has been toward contraction. In services, the trend has also been toward contraction, but as you can see, it's held up reasonably well until it didn't. And most recently, you can see the past 2 months especially, both see shedding employment in sort of the full breadth of the non-farm sector. So that, of course, tells us that there is downside surprise risk. The implications of it for the price component, likewise, critical. Notice we absolutely collapsed on the pricing component in services in this most recent survey. As a matter of fact, the price component grew at the slowest rate since March of 2020, which is the low that we'd set at the onset of the COVID-19 pandemic. So looking at just the ISM numbers here, we have all the indications that we might need to say, whoa, 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 the business cycle is not doing great. We have the slowdown that the Fed has been attempting to engineer. We have falling inflation. We have weakness in hiring. We have the makings of a weak wage number. We have the makings of soft job creation numbers and a higher unemployment rate. This is going to be the kind of report that validates the Fed and pours a giant bucket of cold water over market bulls. Well, let's take a look at how this has evolved. So you can see here, it's looking pretty clear. The green line is the baseline for how many rate cuts the Fed thinks it's going to need to do this year. They set it at 3 rate cuts or 75 basis points in December. They kept it unchanged in March, despite that run of better than expected data that we just looked at. Whereas the markets started off the year calling for an improbable 6 cuts over here. And stocks were able to rally as long as the spread between where they thought the cost of money is going to be called for cheaper money than what the Fed was calling for. You'll notice that as soon as we got over this line, stocks stopped rallying. We immediately got pinned in place here. This is the S&P 500. And as you can see, it was able to rally first when more rate cuts were coming into the system. As far as expectations go, of course, this gray bars thing over here is the implied rate change in Fed funds futures. So this is what the markets are pricing in. As you got more rate cuts, stocks rallied. By the way, you can see that as this stalled here, so did stocks. When you opened the year, the spread between the markets and the Fed was the Fed's going to have to cut way more than it's accounting for. And of course, the markets love that. And so stocks keep rallying as long as the spread is in the favor of cheaper money. Soon as you get durably on the other side, stocks get stuck. And so this is really the key thing that we're going to look for here. If we get a situation where the data is weak, that means more rate cuts, probably good for stocks, probably good for bonds as yields come in, probably not so great for the US dollar, which you can see has very clearly followed what's going on with policy expectations. And when there are more cuts, and so the yield on dollar is less attractive, it goes down. When there are fewer cuts, it goes up. And most recently here, as you got into fewer cuts here, the dollar again gaining steam, and now getting a little bit soggier as this starts to wobble. So if you get a situation where fewer cuts are on the menu as a result of this data, and it leans toward higher surprises, as most data has recently, a stronger dollar follows. If what ISM is telling us is more right, the dollar is in trouble. Similar story for the yen, which is very much a creature of sentiment and a creature of rate expectations. Fewer cuts means higher yields, means a weaker yen. If the cuts start to build out again because the data is weak, this is a tradable bottom. If not, then perhaps the yen continues to be underwater. And that is macro money for today. We are, as ever, here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean going forward. I'm back on with Chris on Fridays, that is tomorrow, for Futures Power Hour. I'm on with Tom and Victor for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you for Futures Power Hour tomorrow, and Macro Money's back next week. Happy trading.